Statement number one in Retirement Fact or Fiction Investment Edition. Number one, the stock market is too risky for retirees. Fiction. And Haley, why is this fiction?
Well, because the stock market, we need it. It's a powerful tool for retirees because we need to balance growth within their overall portfolio. Otherwise, their portfolio could safely lose to inflation. However, that doesn't mean that your retirement needs to feel like a roller coaster ride, which is why when we get together with our families, we try to help them identify the amount of risk they're taking, the amount of risk they need to take in order to accomplish their goals. And that way they can have expectations that are aligned with how their portfolio would react when the market goes up and when the market goes down.
But Loren, that stock market can feel like a roller coaster ride. People who are watching today that are 57 and older, they can go back not too terribly far and really remember some times in history when the market has tanked.
Yeah, we can go way back. We can go back to the Gulf War. Do you remember that, Molly? You probably don't remember that.
I do. I was young. I was in elementary school, but I sure do.
Yeah. But really what most people are thinking about is this century, right? So let's just go the turn of the century. We have the dot-com bubble. If you remember, that was 2000. 2001 was 9/11. And then we have the Great Recession of 2008. And that felt really messy. That recession lasted 18 months, which is longer than normal. And then we have, of course, COVID. 2020. Again, the world was on fire and there were a lot of questions as far as when is that pain going to actually end. And in that time frame, there was a lot of financial pain, but there was also a lot of emotional pain and uncertainty. You put all of that together. When is this going to end? However, what you're looking at there on the screen, look at the long term. That's really interesting. Way back in the 80s, the market was down below 1,000, and then look at where the S&P 500 is now. That is a tremendous amount of growth. You can use that market to your advantage, whether you're working, you're a couple years away from retirement, or even if you're in retirement, if you use it how it's designed.
But Haley, how you use it as you get closer to retirement changes. How you're using it in your 20s and 30s and 40s. You've got to evolve as you get a little bit closer to retirement.
Yes, your investment plan should look different from when you're in your accumulation years to versus when you're in your retirement years. And the reason why is because you need distributions in retirement. You need to provide a paycheck, and often that paycheck could be from your investment portfolio. So at that time, a lot of retirees, they want certainty and stability around their retirement income, and therefore they might want to take some risk off the table for when they get into their retirement years so that they can have more certainty around that income that we deliver from the portfolio.
So the takeaway is it's not too risky, but you want to use it to your advantage in retirement.
Yeah, you want to use it to your advantage. You can't just sit around in really safe investments throughout the entire retirement. But sometimes people feel as they get closer to retirement that they no longer have time on their side. They feel like their investment clock has expired, if you will, but that's not necessarily true. On average, people retire around age 62. It's 62 or 63. So you might have a 20-year retirement time frame that you now have to invest for, provide income for, and the market downturns, as painful as they feel, and as bleak as the future might seem when we go through them, don't usually last all that long. If we go back to the late 30s, in fact, there's only been 2 different times that the S&P 500 has been down 3 calendar years in a row. 39, 40, 41, and then 2000, 2001, 2002. 2 times that the S&P has been down 3 consecutive years in a row. Over that same time frame, there's only been 1 time that the S&P 500 has been down 2 years in a row, 73 and 74. Every other time, 1 calendar year, which means when it gets ugly, when it gets painful, the brighter side is just around the corner. And if we make bad decisions during that pain, what we often find is that is going to hurt you and not put you in a better position. The best market days, what we see, often comes after the most painful time frame. So we have to wait for those best market days, go through the time frame, and having a plan in place, like you mentioned, that investment and income plan will often enable people to do that successfully.
Thanks for watching. If you like this clip, check out the full episode right here. We'd love to keep you in the loop. Hit subscribe to be connected with other pre-retirees just like you who are looking for engaging and entertaining retirement strategies.